Welcome, dear traders. You are watching a recap of the Asian session. In the morning, Asian stock markets moved up, although their growth was rather moderate. China's inflation data turned out to be rather weak. The indicator was lower than expected, signaling economic problems. And this week, US inflation figures are on tap. A bit later, the earnings season will start, and the US dollar kicked off a new week with a rise. The yen tried really hard to grow, but it faced strong bearish pressure. The producer price index in China dropped at the fastest pace in the last 7.5 years. The indicator decreased by 5.4% in annual terms. The consumer price index was flat in June, its lowest level since 2021. Analysts wonder whether the government will adopt new stimulus measures to boost demand. Headline inflation is expected to reach about 1% by the end of this year. The People's Bank of China will continue to cut rates. The main support for the economy will be provided through fiscal policy, and China's shares rose for the first time in 4 sessions, recovering from losses in the previous 3 ones. Weak data from China fueled hopes for new stimulus measures in the near future. A moderate drop in the US stock futures has limited upside potential as investors are cautiously waiting for the US inflation data. Friday's jobs report confirmed that the Fed would raise rates this month. Asian stock markets are still gripped by bearish sentiment. The MSCI AS Far East X Japan index fell by 1.5% last week after a 3-week losing streak. Meanwhile, the MSCI World Index showed an increase of 11% since the start of the year. The main reason for the weakening of equities is a contraction in China's economy. Inflationary pressure is likely to persist in the coming months, which may trigger deflation. The central bank and the Chinese government are now facing a serious challenge. With the deflation and slowing growth, it's not surprising that Chinese stocks, bonds, and the national currency are declining. Shares of Chinese banks included in the Hang Seng Mainland Bank Index fell by 10.5% last week. This is the biggest drop in the index in the last 5 years and the third largest since its creation in 2011. Janet Yellen's visit to China ended on Sunday with no apparent success. Yellen noted that her dialogue with the Chinese officials was frank and fruitful. Nevertheless, there are significant disagreements. This week, investors should pay attention to the policy meeting in New Zealand as well as lending and trade figures from China. The US dollar index dropped last Friday due to the downbeat non-farm payrolls report for June. In the Asian session, it managed to slightly recover. It rose by 0.2% versus its main rivals, yet it was still trading below 103 points, which was negative for the traders betting on a bullish sentiment. If it consolidates below the support level of 102.75, it will be a bearish signal for the speculators. Time will show whether the greenback will be able to rebound. Despite discouraging jobs data, the majority of traders are confident that the Fed will hike the key rate at the next meeting. However, if a fresh inflation report is weak, there is a chance that the regulator could skip a rate hike in September. So the trajectory of the US dollar will mainly depend on inflation data. Meanwhile, prospects of a further tightening by the central banks are causing volatility in the bond markets. Last week, the yield on a 10-year US Treasury notes advanced by 23 basis points. On a Monday, the yield on the 2-year US government bonds reached 4.95%, and last week it rose to a 16-year high of 5.12%. The growth of Treasury yields in advanced economies also triggers sharp movement on a forex, especially when it comes to carry trade. Investors buy the yen on the cheapest price to invest in the high-yielding emerging market currencies. Many traders closed short positions on the yen, which led to the strengthening of the Japanese currency last week. The yen-dollar pair advanced by 1.4%, hitting 142.10 yen per dollar. However, on early Monday, the movements of the yen were chaotic. The USD JPY pair started the new week on a positive note following a slight rise in the US dollar and later gained 0.4% in the Asian session. The US dollar as well as the Treasury notes are growing amid expectations of a rate increase by the Fed in July, yet interventions may limit any significant growth of the pair ahead of the publication of the US Consumer Price Index on Wednesday. If the pair drops below 140.05, it could tumble to 136.70. On Monday, the Australian and New Zealand dollar slid amid weak data from China, which is the largest trading partner of Australia and New Zealand. The AUD-USD pair fell by 0.4% to 0.6660 after rising by 1% to 0.6700 on Friday. The Australian dollar has been unable to break through this level for the past 2 weeks. Philip Lowe's speech on a Tuesday may affect the trajectory of the Aussie, and the pair could try to start a bullish correction in the test 0.6735. After that, a decline below 0.6245 looks likely. If the Aussie suddenly grows and breaks through 0.7045, it could jump above 0.7375. The New Zealand dollar also lost ground today. The NZD-USD pair shed 0.4%, dropping to 0.6175. On a Friday, it added 0.8%, reaching 0.6219. The support level is located at 0.6177. On Wednesday, the Reserve Bank of New Zealand will announce a rate decision. Market participants tend to believe that the regulator will refrain from raising rates. However, it could hike the key rate to 5.75% in November. As for reports that may impact the kiwi, you should pay attention to retail sales data. The NZD-USD pair may try to begin a correction this week and test the resistance level near 0.6225. After that, the quotes are expected to fall to 0.5545. If the NZD-USD pair rises and closes above 0.6435, it may jump above 0.6695. That's all for now. Hit the subscribe button and keep close tabs on the market developments with us. See you soon.